2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. U.S. stocks moving higher after the latest consumer inflation report revealing easing prices in April. That the Dow is under pressure due to United Health. Looking at Honda shares, also under pressure as the company expects a $3 billion hit to annual profit. The automaker citing the impact from U.S. tariffs on cars and car part imports. Under Armour reporting better than expected net revenue for the fourth quarter. The company only providing an outlook for the first quarter amid trade policy uncertainty. The company seeing first quarter revenue down 4 to 5% compared to the same period last year. And First Solar shares are surging as JP Morgan highlights the company as best positioned to benefit from the U.S. budget reconciliation bill. First Solar also getting an upgrade at Wolf Research to outperform from peer firm. Wolf is noting the company's domestic moat remains intact. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code below.
Welcome to Wealth, everyone, brought to you by Synchrony. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we're breaking down the latest inflation prints. We'll examine the cost of things that impact everyday Americans, like eggs and cars and childcare. And, of course, we got to talk about some Social Security changes during this show that you need to watch this year as well. Our senior columnist, Gerry will break them down. Plus, the eye-watering dollar amount one expert says you need to have saved up to be ready for any emergency. We'll give you that figure just a little bit later on. But first, let's begin things as we always do, taking a look at some of the market action. We're 90 minutes into the trading day. Stocks, they're mixed. Following Monday's rally fueled by the U.S. and China agreeing to temporarily reduce tariffs. Investors now digesting today's CPI report showing inflation cooling in April. Joining me now, we've got Malcolm Dorson, who is the Global X Senior Portfolio Manager and Head of Emerging Markets Strategy. Great to have you here with us. So how are you looking at the state of markets right now? Coming off the rally, we've now seen the S&P 500 essentially get back into territory and perhaps on pace to erase some of the losses that we've seen over the course of this year.
Well, thanks for having me, Brad. Big picture, I think investors are incredibly underallocated within emerging markets. We see the average retail investor has roughly 3 to 5% exposure to the asset class. And if you look at what the benchmark says, you should have about 10.5%. And emerging markets make up 25% of global market cap. So people are dramatically underinvested coming out of a period of really significant U.S. outperformance. And now that we've reached this period of sort of uncertainty, the main questions we're getting at our Global X Portfolio Consulting Group is people are looking for a second set of eyes saying, how do I find diversification? And we think emerging markets is a key area.
And so where within emerging markets are there specific regions that you're looking at?
For sure, because historically, people used to be happy buying the index in emerging markets.
Right.
But now if you take a look at it, it's over 80% Asia, about 37% China, 26% state-owned enterprises. There are a lot of areas within EM that people don't want to touch, justifiably. But there are also pockets that present a ton of opportunity. So right now, we're most excited about, depending on what perspective you want to look at it, but from a long-term structural opportunity, India is a compounding machine. Our fund, NDIA, has been getting a ton of attention. From a value perspective, that I know a lot of investors, not only want to preserve wealth, but they see that as the best way to grow wealth, getting in at cheap prices. Greece trades below book value with a 7% dividend yield, and it's now an investment-grade sovereign with some of the fastest growth in Western Europe. And then in addition to that, we kind of take a look at a contrarian opportunity in Brazil. Yeah. Brazil just hiked interest rates to 14.75%. It's a powerful carry trade. We think that is now going to contain inflation. By the end of the year, rates should start coming down. And historically speaking, in Brazilian rate cutting cycles, the average rally has been 96% versus the average drawdown being 17%. So we really like that risk-reward setup.
What is the checklist for emerging markets amid geopolitical tensions and a lot of the trade talk that still need to be netted out and formulated into deals that we're all awaiting some of the details around?
Sure. So starting out with trade, we think that coming out of the election and his first few months as presidency, Trump's all about the deal, the art of the deal, and the way that he approaches things is through sort of an anchor-based negotiation tactic where he really likes to weight to one side or anchor things to one side, starting out with sort of a worst-case scenario. And that created a lot of volatility in EM, but it also created windows of opportunity. So whether it was China, Colombia, Mexico, investors who paid attention to this got in quickly and have been able to benefit from the upside. So now we're trying to scan this universe and see who's aligned with Trump's policies and where are we going to see a deal next. So we have this 90-day reprieve with China, fantastic, but India is going to be a very interesting opportunity, and we've seen really strong negotiation outcomes coming out of that, with J.D. Vance visiting New Delhi a couple of weeks ago. We think Argentina, with President Milei, is very aligned with Trump, that we should see some news coming out from the southern hemisphere as well.
When you boil it down to, and even refine further to a sector-based approach within specific markets that you would like to invest in, how do you identify which sectors are best positioned to be a core or pillar of some of the trade deals that we're still waiting to come through here?
So it's a good question because there are two different ways to approach this. From a sector perspective, looking at the deals and kind of from a more tactical opportunity, you'd probably be looking at areas where these countries manufacture and export, whether it be electronics in Northern Asia, whether it be commodities in Latin America or in the Middle East or in parts of Africa, or whether it be pharmaceuticals coming out of India. But that is more tactical. I think longer term, when you're approaching emerging markets, you kind of want to differentiate old economy versus new economy. And EM historically has been kind of making something or digging something and taking advantage of cheap labor, and these are asset-heavy, low-return business models. But looking forward, these companies have evolved. They have really strong private management teams now, and you have a lot of opportunities more in consumption, in the services sector, which are offer higher levels of profitability, higher growth, and overall better corporate governance. So long term, that's where we like the compounding opportunity.
Just lastly, while we have you, we know that there, of course, is the meetings that are taking place in the Middle East right now. The president starting his international travels, and a few of the CEOs also tagging along, trying to be not just flies on the wall, but perhaps critical voices in these conversations. What should you be watching for, even as the president is going through these international visits, and where this could net out in some investment opportunities?
Yeah, looking for deal headlines. So the Middle East is very interesting because it seems like Saudi Arabia in particular is really playing ball. Near term, I think that might create a headwind for Saudi's market, but they're long-term thinkers. It's Vision 2030 and beyond. So yes, near term, we're seeing a weaker dollar. Saudi Arabia's currency is pegged to the dollar, so that could be a negative for Saudi and other Middle Eastern countries as well. And same in terms of lower oil prices. But longer term, having a strong relationship with the U.S. is going to open a lot of doors for them, and I think it should be a net positive. So near term, what we look for is saying, okay, this arrangement's being made with the Middle East. Energy prices are coming down. We're seeing some sort of volatility. People are looking at gold a lot these days. Who benefits from that? And that's where I kind of come back to India again. India imports 80% of their net energy needs, so low oil prices really help. The average household savings in India is made up 20% of gold, so consumer confidence is booming. They're now starting to cut interest rates because inflation's come down, and it sets a really nice picture for them.
Interesting. Malcolm, thanks so much for taking the time in studio with us.
Thanks for having me, Brad.
Absolutely.
Appreciate it.
Now time for some of today's trending tickers. We're watching Under Armour, Intuitive Machines, and CyberArk. First up, Under Armour topping revenue estimates in the fourth quarter, boosting optimism around a turnaround for the retailer. The revenue in the quarter that fell 11% to $1.2 billion, but analysts expected a decline of 13%. The company provided an outlook solely for the first quarter of fiscal 2026 due to evolving trade policies and the macroeconomic environment. They see revenue falling 4 to 5% compared to Q1 of fiscal 2025. Next up, we've got Intuitive Machines soaring as the company reaffirms full-year revenue guidance of $250 million to $300 million. The midpoint of the number is positive, and it's above the street's estimate here. The company sees positive run rate adjusted EBITDA by the end of 2025 and positive adjusted EBITDA into 2026 as well. And finally, security software firm CyberArk reporting earnings and providing what many see as conservative guidance here. The first quarter results beat estimates in the firm, raising its full-year profit outlook to $3.73 to $3.85 a share. That is from the previous range of $3.55 to $3.70 a share. TD Cowen calls these results strong. Stephen says the results reflect continued fundamental growth and strength for the company. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up on the other side of this short break, we'll dig into the latest inflation print. We're talking egg prices and car prices after the break. Some relief for consumers at the grocery store. Egg prices falling in April, dropping 12.7% from the month prior. And while that is significant improvement, prices are still up nearly 50% from a year ago. Will we keep seeing this downward trend? That's the big question here. And here to react, we've got Tom Flocco, good friend of the show, and Pete and Gerry, CEO. Tom, great to have you here in the studio with us.
Very good to be here.
Let's discuss this. I mean, what are you seeing on the production front? Of course, the avian flu was one of the larger considerations and headwinds for the egg business, driving prices higher.
Right.
So where are we at in the kind of the you are here map of all of the egg price brouhaha that's been everything from campaign talking points now and also been hitting a lot of the prices at households as well?
Correct. Yeah. So just a reminder that there really are two different egg worlds out there, egg markets out there. They're the conventional eggs, which are getting all the headlines. So what you just read were prices of caged or cage-free eggs. Our eggs, Pete and Gerry's and Nellie's, are specialty eggs, which
premium.
Yeah, premium. So free range and pasture-raised eggs. So the birds get access to the outdoors. That group of eggs, the specialty eggs, have actually not gone up nearly as high. We haven't taken a wholesale price increase to our retailers in the last 18 months.
Interesting.
But the ones that get all the headlines are priced off of Urner Barry. And that's all a supply and demand, number of hens out there, laying the number of eggs will increase the amount or decrease the amount of supply if the hens go down. So we all know about 30 million hens, unfortunately, have been culled since the beginning of the year. That's what drove the prices up. Now those hens are being repopulated, but it takes a long time. It takes 6 months for a hen to get to full laying age. So to put on those new hens and then for those hens to start to repopulate and produce eggs for the market, that's why you're starting to see prices come down, but they're not coming down as far as they were, the place they were last year. So we're making progress.
So how's that shaping the outlook right now for where egg prices may continue to trend as well?
So again, the specialty eggs, I don't think you're going to see, you shouldn't have seen big spikes, so you shouldn't see big declines. The conventional eggs, we should start to see come through the summer out into the third quarter. You should start to see prices really start to regulate. They've already come down in Urner Barry more than 50%. And you'll continue to see that work its way through. Demand slacks off a little bit in the summer. People bake less, so that gives the producers a chance to build up some inventory, which also helps moderate prices. So there's some dynamics that we think are going to, provided the bird flu doesn't come back. It's been very quiet the last month to 6 weeks. We only had there's one conventional, or I guess it was a cage-free facility in North Dakota was hit about 2 weeks ago, lost about 500,000 birds. But that's been the only big hit for quite some time.
How big of a risk is that we could see a resurgence?
Well, it follows migratory birds. It's definitely a virus that has gotten more potent. So could it come back in the fall? There's always that chance. That's when we saw it last year. We just don't know. Now, the good news is I think a lot of farms have gotten a lot more serious about their protocols for safety, for biosecurity, tightened up a lot of issues that they might have had. Our farms we're on over 300 farms around the country. Most of them are family farms. For those people, they're not coming on and off a lot, so there's not the opportunity to track the virus in from another facility or something like that. So our farms our farming model protects our birds. Our birds get outside, but they're protected on the inside by a lot of high biosecurity.
I wonder what you're hearing on aggregate from the retailers, those who are relying on customers adding eggs to their basket week in, week out right now.
The retailers, they've been in a very tough spot. Eggs are a traffic driver. People remember what they pay for eggs, usually eggs, bananas, and milk. And so people will base a lot of their other shopping decisions on eggs and egg availability. We, as well as others in the industry, have been working very hard to keep retailers in stock so that their shelves aren't empty when consumers come in. But we're not all the way where we need to be yet. And so we're working with our retail partners to improve that level of supply. We're also helping them educate consumers at the shelf, because in the end, when a consumer walks in and they think cage-free and free-range are the same, they're not. Right. Cage-free birds don't get outside. Free-range birds do. Educating the consumer on that is one of the reasons why our eggs can be a little bit more expensive than cage-free, but a lot better for the bird, a lot better for the egg. It's a better tasting egg, it's better for hen welfare, it's better for the environment. So those are some of the things that we lean into with our retail partners to help them make the egg set a little better experience for their consumers.
Tom, always balanced, always giving us some insight, and of course we love to see the CEO lens, really to know how you're navigating this environment and what you're hearing from consumers, your customers and retailers as well. Thanks so much for taking the time.
All right, Brad, thank you.
Good to see you. Used car prices fell for the second month in a row, according to the April inflation print from the Bureau of Labor Statistics, known in your hood as the BLS. Prices are down 0.5% in April, but still were up 1.5% from a year ago. Meanwhile, new vehicle prices, they were flat last month, but rose slightly on a year-over-year basis. Here with more, we've got Greg Migliore, who is the editorial director at AutoGuide. Greg, just take us into your reaction from the print first, and then we'll get into some of the other, of course, major drivers of what's taking place broadly here within the mindset of consumers.
Sure, Brad. Well, thanks for having me. Good to see you. I mean, right now, the car business is still trying to sort out the impact of the tariffs. And I think that was evident in the better than expected CPI numbers and some other numbers you mentioned. We haven't seen a dramatic, immediate effect on pricing due to tariffs. I think there just really wasn't enough time to feel the impact. But we are seeing these tariffs hit in other ways. So we're starting to see fallout as companies like Honda and Nissan are expected to report lower profits. Ford even specifically called out that its tariff hit is going to be $1.5 billion this year. So I think we're in kind of a wait and see mode right now as far as some of these immediate impacts for consumers.
And so what is the overall kind of sentiment that we're seeing among consumers who are both hearing from car brands that they are, putting vehicles out on the lot, the non-tariff vehicles on the lot, and then additionally, how consumers are just trying to make sure that they aren't seeing a higher price when they know that from a range of countries and how vehicles are produced in essence, that there could be some pass-through costs that they may incur one day and trying to front run that instead.
Well, I think it's actually pretty confusing for consumers right now. You're thinking to yourself, hey, should I rush to the dealership and try to get something before the car I want is actually impacted by tariffs? Should I wait? Are the tariffs going to actually happen this week or this month? So it's definitely a confusing situation. That being said, it's actually been a pretty good year for car buying. The seasonally adjusted selling rate was over 17 million by a lot of metrics the last couple months, which is a very strong performance for the U.S. auto industry. You are seeing some companies like Stellantis, for example, offering employee pricing, which is where they, try to make it basically a cheaper, one cost sort of price. And companies are getting aggressive, which I do think that could benefit consumers. The auto industry is used to operating on a very low margin circumstances for many of their products. They're used to this increased competitiveness. They're used to macroeconomic headwinds. It's all sort of par for the course for the car business. So in some ways, I think the car world is uniquely positioned to deal with these headwinds.
And so with that in mind, what about on the used vehicle side? I mean, we've even heard the strategy from companies that are in the rental space, but also have a used vehicle sales arm like Hertz, and within their own recent announcements, talking about a company's cornerstone sell right strategy, trying to maximize value, improve unit economics, and ultimately leaning into how they can communicate their own value proposition amid some of the tariff-driven pricing dynamics that they're seeing with used car prices rising and what they essentially label as DPU declining here. What does that ultimately mean, especially as you hear companies like Hertz talking about their best quarter for retail vehicle sales in the first quarter of 2025 and where that's moving consumers to?
Well, I think when you're trying to get yourself a deal, you think used car, right? It's just a natural sort of consumer reaction to price hikes that we think will impact the new car market. I think it's a frustrating time for consumers on the used car front because you're seeing prices basically higher than ever. I saw a figure that said they were 28,000. That was the average price of a used vehicle earlier this year, which to me is it's almost an astronomical figure. You don't expect to pay that much money for a used car, even if it were something more in the premium space. So again, I think it's a frustrating time for consumers. But for companies, that do have large fleets that they're trying to offload, I do see great opportunity. You have a chance to get in there, perhaps, cycle through some vehicles you might like to, offload from your general rental fleet or whatnot, move the metal and make a little bit of money. So I think for companies like Hertz, it's a great time to, frankly, make some money and try to even reach new consumers, remind people that you're out there. And it's like many things in this economy. It's not really good for everybody, but for certain segments of it, there's really some spotlight opportunity.
So how is that influencing the summer outlook then for car buying?
So I think this summer it's going to actually be a decent time to buy a car. I think the summer buying season for the car industry, you get into like Memorial Day and then right through Labor Day, people are going to dealerships. That's usually a time it's nice out. People are interested into getting something new and setting themselves up for, the rest of the year, school year, the winter. It's human nature, right? So generally you see decent foot traffic and companies are pretty aggressive. I saw that the average, incentive was over $3,000 last month, which is actually a pretty hefty amount of cash on the hood for vehicles. Credit is still reasonably available. It's not quite as good as it was, but for most people, it's out there. You can use it to finance your new vehicle purchase. We're seeing longer and longer car loans in excess of 72 months because people know that, hey, you can maybe spread out that payment over time. Is that the best financial decision? Probably not, but it helps you get into a new vehicle. So I actually think this summer is going to be a decent time to buy a car.
All right, Greg, we're going to be watching closely. Maybe I'll go kick the tires somewhere, maybe. Appreciate the time.
Thank you.
Coming up, changes to Social Security, what you need to know after the break. We are excited to partner with Synchrony Bank, our premier sponsor for Wealth. Synchrony Bank is working with Yahoo Finance and Wealth to bring you the insights for your personal finance playbook and help you make your money work for you. Let's get a check of the markets here as we're 2 hours into trading on the day and taking a look at the Dow Jones Industrial Average. Here's what we're keeping close tabs on here. We got a little bit of ground, fractional percentage ground to make up to be back in positive territory on the year to date. However, the Dow is down by about 0.3% right now. We'll continue to watch that. The NASDAQ composite has ultimately still about 1.5% in a move higher that needs to be made to get back into year to date. Actually, it's still down 1.5% year to date. It still has more than that of a move to the upside that it needs to make in order to get back into positive territory. All things considered, it's moving and grooving here today. It's up by about 1.6%. S&P 500, that back in positive territory. Year to date, that's up 0.25% right now. Let's dive just a little bit deeper for a hot second into some of the moves that we're seeing transpire here on the day. And for that, I first want to take us to some of the sector activity that we are tracking. As you're seeing on your screen, likely at home, and here we've got it loaded up here on our screen as well for the Wi-Fi Interactive. More gainers than laggards. Right now, pulling up caboose, you've got healthcare, likely being weighed on by some of those moves that we're seeing out of United Healthcare. We'll get into that in a hot second. That's down by about 2.5%. But leading the pack, look at technology, blinding me with science. My gosh, we're up 2% here on the day. And then additionally, energy, and you're seeing communication services joust for that second spot as well. Taking a look at the NASDAQ composite, you are seeing a lot of green on the screen, but a fair amount of red as well here. But more green is transpiring to the upside here. Palantir, that's leading the pack. You've got Alex Karp, CEO of Palantir, also traveling internationally, trying to be a part of some of the deal making taking place in the Middle East. And so that, as we're seeing a range of other CEOs also present, NVIDIA's Jensen Huang also out making some rounds. And then just lastly here, taking a look at the Dow 30 components here. And this is where I actually just wanted to briefly touch on some of that healthcare move to the downside here. I'll put this on equal just so you could see the biggest laggard on the Dow today is United Health Group. They have an executive changeover taking place. Shares are down 16%. J&J and Merck also moving lower here. We'll continue to watch that. Could be some pharmaceutical moves on the tariff front coming forward. We'll be bringing that your way. Switching gears, the Social Security Administration has seen a number of changes under the first 100 days of President Trump's second term, including a new commissioner for the agency. And here to break down the changes, we've got Yahoo Finance senior columnist Gerry Hannon. Gerry, what do we know?
Well, great to be here, Brad. You know, there's just been so much change at Social Security. There have been thousands of jobs eliminated. There's lots of field offices that are set to be closed. So people have been pretty concerned about all the flux surrounding Social Security. And so there's about 6 things I think we could run through that we're seeing as really kind of things to pay attention to that the new commissioner is going to have to be responsible for. And the first one is something that I believe you and I have talked about before, but the Social Security Fairness Act is something that is a good thing that was passed by bipartisan support. Biden signed it into law. And this is something with Social Security that individuals who worked, say, as a teacher or as a firefighter or any sort of job like that, did not have Social Security attached to it. But at another time in their career, they did have a job that they paid into Social Security. Because of things like the windfall elimination provision, and there was another one called the government pension offset that made it, these folks weren't getting the Social Security they paid into. This changed that. So this year, they've started to see either a partial or all of that repaid to them, which is a good thing. But we've had some other things that are a bit concerning with this administration. People who were paid too much into their Social Security. Now, this can happen. The government sends you a check that is more than your check should have been. And these mistakes happen. They're errors. It's no fraud involved here. It just happens. And it takes a while for it to be recognized. And under the Biden administration, when this was discovered, people would have to repay that money, 10% or $10 out of each of their checks. Under the Trump administration, they bumped that up that you needed to pay 100% of it out of every check until you made up the amount that was overpaid. Then they reversed that, or I should say reduced that from 100%. Now, starting April 25th, I believe it is 50% now. So that has come down a bit, Brad, but that still can be pretty onerous on a senior who's depending on that check to meet their monthly cost of living to all of a sudden have it reduced.
So with that in mind, the next 2 on our list are changes under Trump: default withholding rates and garnished benefits from student loan debtors. What do we know on that front?
Yeah, I'm glad you brought that up. Yeah, I think, well, first of all, let's talk a little bit about the student loan thing. I was just on a call with the Federal Reserve, the New York Fed this morning, that shows that student loan defaults have really soared in the first quarter of this year as they've started to be reported again. And under this new provision here, Social Security now, if you are getting Social Security checks and you are in default with your student loan, they can take that student loan debt and start to take that away from your Social Security check, just like they would if, say, you had other sort of childcare support, that sort of thing. So that's going to be back in action again, and that can impact someone's Social Security check if they're defaulted on their student loan. So that is something that I think we need to be concerned about. So moving forward, and then also, I think there was another thing we talked about, the digital ID code, right? Oh no, this is the important thing. I'm sorry to digress. In person and, having to show up in person at field offices to identify yourself. This became a big deal earlier this year about trying to stop people being able to call into the 800 number in order to sign up for Social Security and so forth. And they said, hey, no, we're not doing call-ins. You've got to only do it online or show up in person. This was really hard for people, seniors who didn't have access to online, rural broadband systems, and they lived far from field offices. In order to go in, they backed away from that. So now you still can do the 800 numbers, but what is happening is there's still field offices are scheduled to be closed. The wait times have continued to increase. The number of calls to the 800 number at Social Security have jumped 25% in April over April a year ago. More people are anxious to find out, and more people are turning 65 and retiring and applying for benefits. So we're seeing a surge in interest. But again, Brad, I have to note, Social Security, there was always problems with customer service in terms of wait times and so forth. And I have a friend I spoke to over the weekend. It took him a year to get his Social Security first check last in 2024. So this isn't new, but it's scheduled to get a bit worse. And the final thing is digital ID codes are on the way in June, so that you'll be able to identify in my Social Security account, and you won't need a paper Social Security ID.
Gerry, thanks so much for breaking this all down. A lot to keep tabs on here and some of those changes. Appreciate it. Thanks. Well, Americans are struggling under the weight of child care costs. Prices for tuition, other school fees, and child care, guess what? It rose 0.1% in April, according to the Bureau of Labor Statistics, and it's up 3.6% from last year. We see a similar story with daycare and preschool prices. Although flat last month, they are up 5.4% from last year. Joining me now on set to discuss, we've got Reshma Saujani, who is the founder and CEO of Moms First. Moms First is a nonprofit that advocates for policies to support working women. Great to have you here with us in studio.
Great to be here.
So let's discuss this, especially as we're thinking about the state of child care costs for households right now and where we're still seeing some of those price pressures really impact the household budget.
Yeah, well, listen, I mean, parents have always been in crisis when it comes to the cost of childcare. 55% of parents are in debt because of the cost of childcare. That is if you're going to find it. You know, we're sitting here in New York City. Every single borough in New York City is a childcare desert, right? And so most women in particular have to choose between like funding their daycare and feeding their babies, which is unconscionable. And so parents are desperate to not be priced out of parenthood and to, you know, implore upon leaders to reduce the cost of childcare. And we're at Moms First have been really working to kind of build that voice, put the pressure on politicians to actually do something about it.
What have you found in your own discussions that you've been having the research as well that's been carried out that is keeping the costs so high?
Well, I mean, it's just fundamentally expensive, right? The business model of childcare is broken, right? And even the way I think regulation's a big issue. For example, in New York, you have to have a childcare center on the bottom floor. Even though kids live in high rises, doesn't make sense and makes it incredibly expensive. We are not paying childcare workers enough at all. You know, most of them are barely making a living wage. And so when it comes to, like, again, the business model of childcare, it's broken. So somebody has to provide the subsidy. Is it going to be businesses because workers can't work without childcare? Or is it going to be the government? Or is it going to be both? And I would say it should be yes and.
And so with that in mind, we've often seen, to your point, many businesses try to figure out as a talent acquisition or retention strategy how they can lessen the load for some parents. Are those tactics and strategies that many businesses have put forward, are they still applicable? Where do they need to also improve and perhaps go a little bit further? I
mean, we just need more. I mean, we have a Moms First, we have a National Business Coalition on Childcare, over 200 businesses. We took 80 of them to Washington a few weeks ago to kind of lobby Congress to do more in the tax bill, for example, on 45F, CDC, and the CDCTC. And so I think businesses have to continue to provide the subsidy. If government isn't going to get it done, if government is going to continue to leave behind parents, then businesses need to step up. In addition to that, businesses have to become advocates for policy, right? Like, we have to make childcare affordable, period. You know, last September, I got a commitment from President Trump that he was going to make childcare affordable. His viewpoint on this was that once I put in place tariffs, the cost of childcare will go down. We just saw that's not happening, right? The CPI index today said the cost of childcare is increasing while inflation is staying flat. So this administration is not making good on their promises to working families to reduce the costs.
What would you like to see in terms of the next Tax Cuts and Jobs Act as well, where there are certain talks, at least at this juncture, about what would be offset, what wouldn't be offset, what type of exemptions would be put forward here that could actually help working parents?
Well, I was absolutely disappointed with what I saw yesterday in, you know, the proposed tax bill. Number one, they did not increase, they didn't have a meaningful increase on the CTC, right, which many families rely upon.
Tax credit, yes.
And then the CDCTC, which hasn't been increased, you know, in decades, essentially stayed flat. There was talk of actually cutting it. So for every parent should know this, you get a deduction of less than $600 on your child care cost, even though the average cost of child care per family is $11,000. It's not even a drop in the bucket, right? And so you're not seeing this Congress make good on its promise to working families to be focused on affordability. You're also seeing this administration not do good on its promise to focus on affordability. We saw last week, several articles that showed, that kind of talked about, well, this administration's great plans, for increasing the birth rate. Because as you know, the birth rate is at a 50-year low. A declining birth rate is a dying nation. What are the big ideas being put forth by the Trump administration? Medals for mothers, fertility highways, tracking our menstruation cycles. I mean, give me a break, right? We don't want any more gimmicks. We need real solutions. And it's not rocket science of what we need to do. We need to make childcare affordable and provide paid leave, period. And when we do that, we will not price families out of parenthood, and you will see the birth rate both increase, and you will give families choice and freedom to move in and out of the workforce without penalty, because that's what women want, right? Give me flexibility, give me choice, give me control over my schedule and my time.
Just lastly, while we have you here, because you're making great points, and in the absence of some of that action, which we're still waiting for here, as we think about some actionable tips that households can employ right now amongst themselves to make sure that they're taking any type of necessary steps to alleviate cost pressures, what are some of the ways that you've been hearing from parents that they're enacting, different tools in order for themselves to try and make sure that they're navigating any type of inflation they're seeing on the child care?
Listen, I think that the choices that parents have are none, essentially. The amount of mothers that I talk to that are literally choosing between, can I buy diapers this month or can I pay for my child care, right? They're already, their backs are already broken. So I do not think that we need to ask more from our families. I think we need to ask more from our government. The one thing I will say to working families is your voice matters.
Yes.
So get ready, get loud, get active. Elections are coming up, both in the mayoral race, quite frankly, and in Washington in the midterm elections. So let your voice be heard. Become childcare voters. And that's the movement at Moms First we're building.
Reshma, thanks so much for
Thank
joining
you.
us here in studio.
Thank you
Great
for
to have this
having me.
conversation. Coming up, everyone, why one study finds that you might need more money in your emergency fund. Oh yeah, more than you thought. That's next on Wealth. A new study by Investopedia finds that the average American family should have $35,000 in their emergency fund. If that sounds like a lot, you're right. According to the Census Bureau data, it's only roughly 40% of Americans' annual income here. Joining me now in studio, we've got to discuss this study and how Americans can save better. Caleb Silver, Investopedia Editor-in-Chief. Caleb, good to see you here. How did we arrive at this number, and what are the costs that Americans should be aware of?
Yeah, and we're talking about households here. We're not talking about individuals. We're
Great,
talking
my
also
goodness.
about the needs, not the wants, right? The essentials, medical care, cars, health, housing and utilities, food, all the things you were going to have to pay for if you suddenly lost your income. Not talking about the vacation, not talking about the discretionary theater visit. We're talking about what you actually have to pay for if you're raising a family and you need to get through those costs, especially those medical care costs. Those add up to around $11.6 thousand. So we're talking about a fair amount of money, whether you're covered with COBRA, if you lose your job, you have to get additional health care, you have to get additional health care riders, but also most households have more than 2 cars. So we're talking about putting one in the garage and servicing the other and getting gas, things like that, and then housing and utilities. Those costs keep rising every single month. So everybody's number is different, but we took the median household and we took the actual cost of things based on the BLS, based on the Consumer Price Index, based on Kaiser Permanente's family study, and said this is what you actually need if you have to make it 6 months, and people should plan for that.
How does it compare to the average amount that households have saved right now?
Yeah, average households only have savings of around $8,500, and we adjusted that for inflation too. The Census Bureau ran that a couple of years ago, but still, people aren't saving enough because everything costs too much or they're spending too much. So we're talking about putting that money away and putting it in a place where it can grow over time, like a high yield savings account, but that you can access immediately. It has to be liquid. You have to be able to access it if you have that emergency, and you can't have it tied up in a CD. You can't have it tied up in the stock market. And it is a lot of money, Brad, but when you think about what you actually have to pay for, This is kind of what it comes down to.
We often hear about, especially with inflation in mind, the cost of living type of adjustment that your emergency fund also needs to take into consideration. How is inflation and price changes affecting some of these numbers?
Yeah, we took the average rate of inflation, which is somewhere between 2.5% and 3%. We got a nice inflation reading today, but we took that average rate just because things continue to cost more over time. But when you take something like healthcare, where it's actually outpaced inflation, housing costs as well, we had to account for those too. But when you're thinking about what you can't get away from paying for if you want to sustain the household, these are the things you have to be thinking about. Now, if you're single, it's going to cost you a lot less. If you have several children in the family, you're taking care of older family members, it's going to cost you more. It's all about determining what it costs to be you, the absolute essential cost of what it costs to run your household, and making sure you're accounting for that over at least 3 months, but hopefully 6. That's where that 6-month $35,000 number comes in.
If people want to calculate their own 6-month expenses for the household, what are those buckets that they should be tracking in to really give them that holistic figure?
Yeah, medical care and especially insurance coverage, right? What are you going to have to pay? What might you have to pay out of pocket for, God forbid, if something should happen? But automobile is also a big one. You're thinking about maybe if you have 2, putting one in the garage again, doing some carpooling, but still you have to service that car. You got to pay insurance on that car. You got to fill it with gas. You got to think about that. And then your housing and utilities. You can't get away from paying the rent. You got to keep yourself in the house, all of those things that go into that. So it's really determining, and this is the quintessential question in wealth planning, is how much does it cost to be you, and how much does it cost to be you essentially? You want to make sure you have that number times 6 months.
Caleb, great to see you here in studio with us.
Thank you.
Thanks for taking the time. We've got much more on wealth, everyone, after the break. Stay tuned. You're watching Yahoo Finance. If you're saving your child's future, there are a few tax-advantaged accounts that you can put to work for that savings strategy, but it's important to know the pros and the cons of each. Here to explain, and joining me now, we've got Lisa Green-Lewis, who is the TurboTax CPA and tax expert. Lisa, great to have you here with us. Let's just start with an account many parents are probably familiar with, a 529 college savings plan. What are the benefits to opening one for your child?
Yes, thank you for having me. So first, the 529 account, that's great for qualified expenses for college education. So like your anything that you're not able to pay for with other like tuition. So you could pay for books. It could also be used for tuition. And then something that's fairly new over the years, you could also use it to pay for K through 12 education up to $10,000.
So with this in mind, there are also custodial accounts. Explain the pros and the cons of a custodial account for us.
Yes, so a custodial account can also be used for anything that a 529 can't pay for. So for instance, like room and board at college, or even a car, you're able to pay for other items for your kids. And you can contribute up to the gift tax limit without paying any taxes. So the gift tax exclusion is up to $19,000 if you're single, up to $38,000 if you're a married couple. So you are able to contribute that much, and parents can pick the investments that money goes into.
We've been hearing about, and we know parents probably know this well, about this kiddie tax. Could you define what the kiddie tax is for us?
Yes, so the kiddie tax, you would be subject to the kiddie tax with the custodial account, because when you withdraw that money, it's considered income for your kids. And so your tax on your kids are taxed on a certain amount up to their tax rate as well as the parents' tax rate. And their income can go into your tax return as well.
And also here, some kids even qualify for a Roth IRA. What should parents know about opening up a retirement account for their kids?
Yes, so as we all know, the earlier you start saving for retirement, the better. And so with a Roth IRA for your kids, they're getting those years of tax-free growth on income that they're able to withdraw when they retire. And with that, the contributions can also be withdrawn tax-free. If they do withdraw for college, that income can be taxable, but it is also a great way to save for college.
So those are 3 great accounts for parents to keep in mind. Could you also tell us some of the disadvantages that parents should be mindful of with 529s, custodial accounts, and Roth IRAs?
Yeah, so the disadvantage with 529, states have so many different rules on these, and there are also restrictions on the qualified expenses. It's mainly for college expenses. You can withdraw for other things besides college, but you would be taxed on those withdrawals as well as a 10% penalty. And then just the variations of the different types of programs that they have. It varies by state.
Lisa, great to have you here with us. Thanks for breaking down some of these accounts.
Thank you for having me.
Certainly. Let's do a final check of the markets here as we are approaching the noon Eastern Time hour. Taking a look at the Dow Jones Industrial Average right now, fractionally moving lower here, largely being pressured and weighed on by some of those healthcare names, notably UNH, United Healthcare. That's moving lower, double-digit percentage throughout today's session. Take a look at the S&P 500. That's been a key one to track here. We're just a stone's throw away from erasing some of the declines that we've seen over the course of 2025 here. And depending upon when you've been looking at the tick by tick, we were able to get into that ballpark. We'll see exactly where things close out on the day's trading activity. And then also taking a look at the NASDAQ composite. The tech-heavy NASDAQ is up by about 1.6% right now, largely being led by Palantir, NVIDIA, those 2 of the names that are really boosting the NASDAQ here on the day. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton that comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.